What's going on, everyone? I am Charles Moon, the disciple of trend, and this is my podcast, Buy High, Sell Low. Just want to mention that stock and stock options trading does involve a substantial degree of risk and may not be suitable for all investors. Past performance is not necessarily indicative of future results. Welcome back, everyone, to the Buy High, Sell Low podcast, infotainment at its finest. I am the disciple of trend, Charles Moon, your host. Today, we're going to start off with a segment called The People's Champ. Now, I actually called this segment after a gentleman I admire so much. His name is Dwayne "The Rock" Johnson. This is the man, the myth, the legend. Went from a wrestling superstar to being a blockbuster generator. And what this guy is known for is his hit action movies and his charismatic persona and just an incredible crap-talking machine. But not too many people talk about his philanthropy and how much he loves to help people and how humble he generally is towards his fans. And now I'm not saying I have fans, and I'm certainly not going to sit here and claim that I'm some superstar. But this segment is about you, the listeners, the viewers, those that are actually allowing me time out of their very important, busy lives to provide information that I hope will help them grow as investors, as traders, but generally just becoming more informed. Because I feel that no matter what kind of analysis people do, they're just not informed enough. We call that being an informed trader. Now, the first question I got was from Matt. Says, "What up, Charlie? Nice work on the podcast so far. Caught a couple. Plan on catching up the rest shortly. Here's a question I thought about today." So, full disclosure, I run two different trading rooms. This one, he is talking about the Momo room, where I trade larger cap names. He says he likes enjoying trading them. However, holding them overnight would take a big margin hit or percentage of my portfolio. I know I could buy less shares if I have a risk parameter in mind using your stop loss. The amount of shares to buy can sometimes still add up to a lot of capital. So any other way you would advise using these signals called out? Hope that makes sense. Well, let me try and break this down. If you feel that based on your risk parameters, you'd be taking on enough shares that would, in essence, tie up too much of your account, the general rule of thumb is that you would either take the lesser of shares based on risk or shares based on your capital allocation. So whatever your account size is, okay, quarter it, allocate 25%. Divide that by the stock price. That'll tell you how many shares that you could get. Say it's 449 shares, round down just in case there's slippage. Go 400. That would be the easiest way, and it's a really simple risk management, money management rule that you can use moving forward with your trading. All right, David said, "Hi, my stock I have a question about is Amazon is moving higher. Want to know about the technicals." Okay, well, let's say this. First and foremost, Amazon is insane right now. It is extremely strong. So I clearly understand the beauty of trading this name, right? Generally speaking, the consistency of the trend over the last few years have been amazing. This is a 3-year chart where it went from 700 to 2050. The 5-year chart even looks crazier, from 284 to 2050. What? So let's bring it back to the daily chart, where each bar represents a full day and this chart represents a full trading year. Now, most notably, David, the immediate support came in on a pretty sharp drop on June 25th. The 50-day moving average is what comes to mind. Now, it didn't get to the exact level, but it sure was reacting towards that particular price point. Now, this was a good reference just prior on June 14th. This day, June 14th, it actually came down to this level. And in fact, it came really close, about as close as you could get in Amazon. The 50-day moving average, or the 50-period simple moving average, was at 1858.13. The low on Amazon that day was 1859, so less than a point. So that told you, based on recent history, this was a level of support to watch. Sure enough, as Amazon came down, they got towards this level, they reflected, they took out what was an important resistance level, and we know it's resistance because the stock had deflected pretty sharply, by the way, from that price down to this price. We're talking about from 1935 down to 1872. That's a big move. Okay, we're talking about a 30-handle move here. Or, I'm sorry, 60-handle move here in just a 4-day period. But alas, support came in, and then what was a double top resistance point based on July 2nd. The stock peaked above, showing bullish behavior. There was a big battle between buyers and sellers here, but it was also attributed to the holiday week. And then, of course, we've had 3 straight days of higher highs, higher lows, coupled with today, which looked actually quite scary, and it's considered an engulfment bar negatively, where the high is higher than the previous day's high and the low is lower than the previous day's low. It's an outside engulfment bar, which is usually based on how the performance was. In this instance, opened at highs, closed at the lows, so the reaction was very negative. Usually is a sign of weakness to come. Now, if there is weakness in Amazon, quite honestly for you folks, I would really be attentive of that previous high right here, this 1935 price. Okay, I know it says 1934, but I can't draw it exact, and it doesn't lock on. So if support is found at this price that was a double top resistance level, we call that floor trader congestion. It's actually a point of emphasis that I'll touch up on in a future podcast. But at this point, this would be strongly considered a potential buying opportunity. The risk parameter is actually pretty small in all things comparison to how Amazon normally trades. And your downside at this point, you meaning your short-term floor, would be where the 50-day moving average currently is. As of today's date, which is 7/11, podcast is going to be hitting your YouTube subscription, iTunes alert, your overall subscription base, whichever way you listen to this podcast, tomorrow on the 12th. So as of right now, the 50-day moving average is at 1877.53. Okay, that is going to be your short-term floor. However, that is quite a bit of ways from 1935, so you must be comfortable with that type of risk. Quite honestly, my risk is going to be defined at 1890.43. There's 2 little bubbles right here. If it closes below that level, I wouldn't want it anyways. But ultimately, it could still hit that 50-day moving average and bounce. For me, the weakness in Amazon was purely attributed to the tax on big tech out of Europe, right? From France. And then, President Trump immediately had tough talk if they decided to move forward. Well, they decided to move forward, and there was a very negative reaction. Not surprisingly, in names like Amazon and Netflix and Apple. All in all, though, I do expect buyers to come in on this dip because we are in a beautifully, lovely, strongly, incredibly rich run in the markets to the upside. There's got to be a risk-off day eventually. So maybe Amazon gets there quick. What's important is that they react positively, meaning they bounce. They deflect up off of this price level. That's when you know buyers are looking at that price level, and that level is going to be so important in the meantime. It could be what's called a near-term value play. Buy the dip, right? Buy the dip. All right. Next question from Joe. It says, hey, Charlie, just wanted to thank you for the great podcast number 7, actually all of them, on the gaming sector. Awesome information. Going back to watch again. He was just mentioning that he has a son in college. Not sure if he needs to go with kids making $10,000 a month on YouTube. All right. He said he enjoyed the technical podcast when I was talking about the ATRs. Light bulb went off. Oh, this was just more of a comment base. Sorry, I never read these emails. Oh, here it is. Would love to hear your thoughts on NVIDIA and what the future holds in a 6-month, 12-month, and beyond. And Joe, I want to say thank you for the kind words. Same with David and everybody else. Matt, too. Incredible support so far, and I greatly appreciate it. So here's the things that's tied to NVIDIA. What's really important is the ties based on the tariff news, okay? Tariff news is what has killed this stock. You know, the advent of Bitcoin and miners kind of going away and dying out and not really pursuing because the price of Bitcoin was too low to make it worth their while, meaning they would lose money if they try to mine. So sales went down. But listen, the gaming industry is strong. Business applications are picking up. People are buying more personal PCs. That is starting to come back. But that's attributed to the gaming sector. And guess what? Bitcoin started to rally again. And if Bitcoin sustains above 10,000 or more, guess what? The miners are going to be coming back. So we'll have to wait and see. For me, I'm seeing very positive signs in this name. I really like the upside play. The only thing I hate is this 200-day moving average at 173.04. As you can see, I've taken chances in this name, okay? I've done okay. I've done okay in some instances, but all in all, the aspect is that it is still in a long-term downtrend. Now, if we pull it up on the weekly chart here, you could see it was a very strong uptrend, but you could see on the weekly chart, we still have that negative ATR, that sell ATR. We have that buy ATR now. We're seeing positive signs, but that 200-day moving average is going to be a very difficult ceiling to breach. So right now, 173 and then 191 would be the price level to watch here in the near term. There is a pretty massive gap to fill at this 202 price. And I think anything above 202 in terms of NVIDIA, closing above, opening above that level, it could really lead to some newfound buyers coming into this name, and the FOMO trade may, play out where people didn't want to miss out on the opportunity, even though NVIDIA is up like 25% in a short period of time. So it's hard for me to predict the future. I think 6 months from now, NVIDIA will definitely be up more than it is now. However, there's a few things tied to that. One, are the markets going to continue their run? Okay, so there's a few things that we have to be very aware of. The July FOMC meeting is going to be extremely important. Extremely important, okay? Because if they take a quarter rate cut and then they give guidance towards needing some hard line evidence for them to move forward with their second cut, the markets are going to sell off. Markets are currently pricing in as if we are going to get 3/4 of a basis to a full basis point cut almost by September, it seems like, but realistically by the end of the year. I've pulled it up. Well, I won't pull it up right now, but listen, I don't know what to think in that regard. I do know that the markets have been very comfortably moving up. There hasn't been too many down effects. Any down day has been met up with eager buyers in the short term. So it's like stocks could barely pull back 4% before that, they start their rally again. So right now, it's quite a risk-on environment. People have been so afraid of these highs. How much higher can it go? How much higher? It can't go any higher while the markets continue to go higher. Don't fight the tape. Don't overthink it, okay? We stack a couple of 1,000 down point days in a row, which is what's going to take for it to shake up to the downside and get our correction. Yes, then be a little concerned, okay? Be a little concerned. We've had huge shakeups for 2 weeks only to rally on back, and look at where we are right now. S&P 3,000. Dow Jones 27,000. Come on, guys. Historical highs. Just making them today. Yeah, we'll have a down day. Don't be afraid of it. Be excited for it. It gives you an opportunity to buy the dip if one is presented. So 6 months down the road, the market is trending up. The FOMC doesn't screw things up. Maybe China and U.S. play nice, or if they don't play nice, the FOMC moves forward with their accommodation, which is really important. That's the key configuration They're ready for accommodation, okay, by any means necessarily, and they want to be preemptive. Great. Risk on environment. So in a risk on environment, very tough for me to see NVIDIA not thrive. Same thing, with Qualcomm and others, they're allowing Huawei to, work with U.S. companies and all that good stuff. So semiconductors have been under fire. They're one of the strongest performers. They're also one of the most volatile. I'm quite bullish on the semiconductors for the longer term. A 50% retracement from here, from where it was, I'm pretty sure everybody would be happy. All right, last but not least, I had a question from Eva on ARMP. Now, I don't normally give too strong a guidance on names like this. They're a bit of a coin flip. I just don't know. There's a lot of things that need to go right. Of course, if they do, they turn into what's called TNDM. TNDM was a name that I used to scalp in my penny stocks room not too long ago. And then all of a sudden they went from $2 to $71. And that's kind of the ideology with playing ARMP. You got to figure out what you want out of this. Do you want it back at $19? There's a reason why I went from 19 to whatever it was. Okay? So my suggestion is, if you can double up in price, that's an incredible return. Remember, you could always buy back in. You don't have to allow your investment to just whittle away and die. If it provides yield, say 100% in return, sometimes that's more than enough. So it just depends on what your idea of what you want to do with your portfolio, because that's what you control. Now, we've talked about with this company and what they do. I mean, I don't know. A lot of these are based on late phase 2, phase 3 trials with everything working out, FDA approval, and then, of course, it being a step, a product, something that's going to generate large amounts of reoccurring revenue, right? Specialty drugs, it's a niche market. It's a limited upside. The benefit of those companies that do get the FDA approval is that you buy into them hoping they're going to be M&A targets for companies like Pfizer, Bayer, or Bristol Myers, and all those other companies. So, there's a lot to it with the micro bio names in the NASDAQ. I'm not saying that they don't turn into anything. Look at AMRN, look at TNDM. There's quite a few others that, I think Celgene bought out 2 of the names that we used to trade. But limited. We're talking about thousands of thousands, and just like one out of all of them, maybe once a year will make that type of move. Right, where they're pretty much at the 1, 2, or 3 of the biggest gainers for 2019 in the NASDAQ. So we'll have to see. All right, now to get to what you folks have been waiting for. So a lot of my podcasts have been about infotainment, things in the news. I'll keep talking about it, right? I'm going to have my opinions. I'm a very opinionated person. Doesn't mean I'm right. Remember, one of the key themes that we have to say is opinion, not advice. I am not an advisory or investment advisor. I don't offer up any advisory, opportunities. It's nothing like that. Everything that I'm going to talk to you about is going to be based on my perspective. It's what I see. It's what I recognize. And most notably, it's what I find as a near-term opportunity. And as a trader, I am very opportunistic. Now, I may be more informed. I may be more in tune with a lot more stocks. I mean, my watch list is pretty thick in my room. If you go into my momentum stocks room and click on the watch list, we're 200 names heavy. However, I do my due diligence because I, A, set an example for my clients, and B, I obviously want people, to benefit while they are learning. Now, some people don't have any desire to learn. God bless them. But, whatever I do in terms of my return, I know my clients can do through. Okay. And that's the beauty of this. This isn't science. It's a lot common sense, and it's more training your eyes. Now, the setup I'm going to give you is actually going to be considered an aggressive setup. If you've never traded before, it's not one I would recommend for you to take. Even for people that are comfortable with trading, okay, may not be comfortable with this ideology. This is more of a swing-based signal. But I do believe that it could provide up to 20% in a very short period of time. And I'll give my explanation here. Now, two things. I am not going to give you the exact price range because I plan on actually calling the signal tomorrow in my room if the markets rally. I don't want it to be perceived that I am pumping this name up, even though this is a stock that trades on the NASDAQ at 1 to 2 million shares a day. I don't have that kind of influence. I don't have that kind of clientele. Yes, I have thousands of clients, but in the grand scheme of things, our money combined doesn't even sniff the socks of one of these big players in the markets. We are the guppy. And all of us together doesn't make us stronger. It just makes us a pool of guppies for the sharks. So understand where I'm coming from here, okay? But I'm going to give you the breakdowns of what I see. And if you could pick it up, I'll let you decidedly take it on your own if you wish. You are on your own after this, though. We're not going to do any real follow-ups. Maybe I will if it works out really, really well. And I'll kind of explain what I see in the near term and what I'm hoping will happen. And there's a few kind of key things that I've picked up on that I'm going to share with you folks. And what's really important is that we recognize the environment that we are trading in. Now, currently in the Momo room, I don't mean to gas myself up, but we've done pretty well since May. When the markets really went on their strong run and started to trend, we were very advantageous and very aggressively opportunistic. And myself and Pat really put in a lot of work. I mean, it's 9:30 at night. I'm still working because we got to be one step ahead. I don't ever expect our clients to do this. You don't have to. I'm on another level because there's a lot of things that I'm working on, new creations, new opportunities, more ways of taking advantage of the market. So a lot of my studying isn't just reviewing stocks. It's more about reviewing opportunities, newer opportunities. Because if you stay stagnant in the market, if you do not evolve, you get left behind. It's a bit harsh and it's very morbid, but I say this all the time in both my rooms. Adapt or die. Okay? Adapt or die. And the markets, the market environment are transitioning at such a rapid pace now. It's not how it was in the 80s. It's certainly not how it was in the 90s. There are similarities because people point them out. I get that. But those similarities are tied to human emotion. Whereas this type of sustainable rally is not based on emotion, folks. I know there's a lot more people fearful of buying in this market right now and looking to short more. Again, I think the other way around. I'd be afraid to short in this market, and I'm aggressively looking for buys. But the market environment changes so quickly. Look at how fast we went down last August, October, November, December. Look how quickly we rallied up to where? All-time highs. The transition in the market environment is quicker because we are algorithmically driven. We are computer driven. It's way different than, liquidity is getting pulled off the books and just floor traders hammering one price or another. That still does happen. There are days like that it happens. Remember, 60% of the liquidity in the current markets right now are based off of HFTs. Look it up, folks. So because of that theory, right, because the markets have been in this autopilot trend, because these HFT systems are making money way easier right now up than down, we're just seeing this drive to the upside. So it's hard for me to look at stocks that are peaking at 52-week highs that are, basically 110% above where they were at the start of this year, and expect me to just try to pile on at that price. I don't mind buying it on the dip, but that's the problem. These stocks aren't dipping. Now, you may say, well, if a stock is down right now, there must be a reason why. Yeah, I get that too. But there's other signs that tell you that bullish plays, bullish players, bullish buyers, bullish opportunities are all being presented. Today, I bring to you LITE, LITE. This is actually a well-known momentum name. Now, where their 52-week high is, it's on the left of my chart. That's never a great thing. Strength in the trend is when the 52-week high is on the right side of my chart and the 52-week low is on the left side of my chart. Case in point, if I pull up a stock like, let's pull up Team, for example. 52-week low was exactly 1 year ago at $64 even. 52-week high was yesterday. That is one hell of a trend. But let me bring you back to LITE. We'll look at Team. I like Team. I'll buy that dip any day. LITE, I see a great upside opportunity. There's not much value. And what we're starting to see now is money piling into names that offer value. Names like Western Digital, WDC, which was one of the worst performers last year, and then Win. You could ask the investors what kind of pains they had to go through with Win. Even companies like ACIA, which IPO'd with TWLO, started to rally up and show strength. And then, of course, they announced their buyout. They're getting bought out, right? Look at this right here. Where's the news? Who bought them? Oh, Cisco. That's right. Cisco bought them out. Small jump from 48 to 60, 65-ish. But that's the thing. I'm seeing these names offer up great opportunity. Now, if you look at LITE, it's not like LITE didn't rally. They opened this year somewhere around 41.28 and peaked out at 62.95 before plummeting to $40 and then rallying very quickly in a month to $58. On this pullback, we're starting to see what's called higher highs, higher lows. I gave an analysis based on technicals on the price channels. If you notice, guys and gals, the top of the channel has been moving up, and what is the bottom of the channel doing? It's also moving up. This is what I consider a momentum indicator. It'll be yellow when the momentum is showing strength to the upside. It'll turn red when the momentum is showing strength to the downside. Important aspect. Then we talked about the ATR. The ATR must be below as a cardinal rule for a buy. And that's where I'm at. Most notably, this was a pretty nasty reversal bar, but I was really excited to see a lot of technical support come into play. There's 150, 200, and the 20. But what was really exciting was the reaction, the strong bounce. Now, for the candlestick players, you know what kind of a doji that is. But for those that don't know, that is what we call a tail. And the bigger the shadow, which is the tail or the wick, the larger the reaction, the larger the rejection, and the most likely there's going to be potential follow-through. That's what I'm looking for. Now, we do have earnings towards the early portion of August. But right now, we're in this slight consolidation period, and in fact, it started really condensing. We know there's resistance. This is now an hourly chart, which is where I'm going to be looking for that entry. Our resistance is based off of that spike high from Wednesday. And in turn, we're starting to see a squeeze. The top of the channel moved down. the bottom of the channel moved up, which meant the range is getting constricted. This is where we call the jack in the box theory comes into play. For the jack to pop out of the box, there has to be a crank. When you turn, it starts tightening, I think, a coil. Let's just say a coil. And so all this energy gets compressed before pop. Now, of course, if the markets collapse, we could see LITE go this way and break down really aggressively. We're talking about fast breakouts to the downside. But again, we're in an uptrending market. There's opportunity. Today, the Dow moved up like no other. It wasn't up 1,000 points, but it just kept going up. Slowly, consistently, surely. And for me, in a risk-on environment, stocks gap open higher, grind on up. Gap open higher, grind on up. That's the perfect bull environment. At ease, no fears. I'll just buy, check on it later, collect my money. I'm happy. That's the best environment. And so if we keep that environment through July, potentially through August, we're going to see a lot of these value names, regardless of whatever it is, start to rally. LITE, for me, if it breaks above this 53.50 price, has strong potential. The potential isn't to 54. The early potential is up to this 58 range. And so in turn, we're looking at nearly 5% in a very short period of time. How do I know? Well, on one of the bigger range bars here, it traded $4.38, and just a few days ago, it traded in a $2.85 total range. And so on average, LITE trades from low to high or high to low about 2 points a day. So for 5 points in a short period of time, it could technically just take one day, but just a couple of days is all you need to start slowly potentially taking some risk off. Why not use a key resistance level as a great opportunity to reward yourself for being in the market at the right time? At that point, you don't have to take it all off. Even if you just have 200 shares, what you did is that you, in essence, took 50% of your risk off. If your stop was 4 points away on your remaining 100 shares, in this instance, if you take profits here at 4 points and the stock retraces $8 to stop you out, at the very worst, you're walking away basically unch, outside of the commission fees you had to pay your broker for taking that trade. Now, what if you took 4 points of profits here and put your stop at break even? Well, in that scenario, if it comes back and you get stopped out, you walk away gross profit $400. Now, again, if you move your stop 1 point above your entry and it pulls out, you made 4 points on your first 100, 1 point on your second 100. Now you're walking away $500 gross profit. So this would require some simple management at a key technical level. The high there is at 58.23. I would even say, if you want to be very aggressive, start looking at 57.75 before it gets to 58s, before it gets to that 58.23. A lot of clients I have make the mistake of putting their order right on the resistance price. That doesn't make sense. There's going to be orders stacked below that price level. So the stock may not even get to that price point before it starts pulling back. But say a great case scenario happens, right? One of the best case scenarios, it gets above this level and starts moving. My next projectable upside is going to be what's called a gap fill. This gap fill is currently going to be at 63.74. That's close enough. That's a 63.78. Now, if you're unsure of what a gap fill means, it means that the stock retraces to fill the gap. The gap is when the stock closes at a price and opens well above or below where the previous day's close is. When the stock comes back to retrace, meaning go all the way back to that closing price, it's called filling a gap. Now, I'll pull up ACIA. You could see here that it closed at 48.06, and then it opened at 65.58. That's quite a big gap. This gap, if quite honestly, for ACIA's gap to be filled, that means the deal with Cisco fell apart. This is important, that gap fill. And I'll give you another example because this tells me, based on when the reaction is or what that reaction is, that could have been what was a quintessential designated target. As you can see, ACIA jumped up here, came back down, and then reacted. The closing price here was at 47.16. The low here was at 47.51. So it almost came down to fill the gap before it ended up closing at 48.06, or off of the lows. And then, of course, that gap. You see how it jumped? The opening price, the closing price here was 47.16. The opening price was 50.71. Okay, so around $3.60-ish cents, maybe less. That was the difference, the discrepancy between the close and the open. If it's substantial, it's considered the gap. Now, if it's like 3 cents, it's technically a gap, but come on, 3 cents, come on. So this is what's important. Here was ACIA's gap. You could see a gap lower. The momentum drove it down. It came to fill the gap here. I'm going to highlight it to try and fill the gap here. It got close and then deflected back, and then came down to this gap fill here. There's an old adage that says all gaps get filled. That's not really true, but the ideology is this would be the designated target. The target is because this is where buyers will be looking to take profits. On top of it being a key resistance level, aka the swing high before the stock plummeted 33+%. Okay. On top of that being resistance, the gap fill is there. And so that has to be a secondary target. Now, for me, guys and gals, I look at it like this. If this stock gets moving, this potential price range of 63.78 can be hit fairly quickly. Again, this stock rallied from 40 to 58 in less than a month, about 3 trading weeks. If the true momentum is here, the stock starts to blow out, it breaks above this level, in my opinion, it will probably take a lot less time from here to here than it will from here to here, because this would be the potential designated breakout zone. Now, this is me kind of stepping out on the limb because I'm calling for a really exaggerated and a big type of move in a name in a very short period of time. Now, there are a few factors to kind of come into play. One, when is their earnings report? They haven't announced it yet, but at some point, I believe that may be an announcement, but we'll have to see. Usually an announcement will look like this. But if it's anywhere on the 7th, that means we have less than a month to try and make that reward. And I'll tell you right now, guys and gals, if the stock gets above this particular price level, past that gap fill, and it finds that immediate floor here, it's going to be a runner. This is a stock that has potential of hitting into the 70s. We get into the 70s, you're up over 20% on this name. That's big. It is big. Now, quite honestly, we probably have to get to that 75 price. It may take all year to get to that point. But in all honesty, this thing has dropped from 57.83 to $44 in 4 days, it could make a very similar type of rally in a short period of time. We'll just have to wait and see. This is going to be a very wild, almost unexpected, and very unlikely call. So take what I say as a grain of salt. Everything that I'm pointing out here basically has to work out exactly as expected. So it's not that I want to give you a scenario where everything has to be perfect. Listen, I'm pretty sure if you got 10% out of the stock in a week, you guys would be happy. But that's the thing. Once it gets that 10%, then what? If the answer is breakout, I'll be proven right. If it gets stopped, I only give you guys 5 to 10%. I don't think you guys would be too mad with that anyways. All dependent on this stock getting above 53.50, closing and opening on this hourly chart. If that happens, I expect potential magic to come into play. You want to see what I'm talking about? BYND, ladies and gentlemen, was a signal given out. It was a signal that we got filled off of this sideways action that's very similar to how it looked like in LITE. The channels were compressing. Once it started going, it got a little slow and started compressing again. But you could see our entry at 154.23. The stock is currently at 174.20. It's been 1, 2, 3, 4 days. Yes, LITE is not BYND. Yes, I get that. I get it. I get it. I get it. But that doesn't mean it can't be. The float is a little bit bigger, of course. It's still a momentum name. People are searching. This is one that could attract a lot of eyes. Let's keep an eye on it, folks. All right, going to wrap things up. I hope you really enjoyed this particular podcast. Keep an eye out on LITE over the next few days. I'll tell you what, if it doesn't end up triggering over the next few days, you could disregard because I'll give you another one anyways. Once it does trigger, we'll see how it plays out. Do me a favor, folks. Tell me what you thought about this video. Do you want to see this type of content? Do you want me to give you more stock picks? Or do you want to just hear about the general broad markets? Maybe you want a combination of both. Maybe you want me to switch off. One podcast this, one podcast that. I do 2 a week. Your boy likes to work hard. Folks, comment down below. Email me, podcast@prospertrading.com. Message me, at me, right? DM me on Twitter, at me, Disciple of Trend. I'm here for you all. The people champ. Not me, Dwayne "The Rock" Johnson. But I, of course, want to help whenever I can. Hope you found this podcast entertaining, guys and gals. We are going to wrap this up a little bit longer today, but that's expected with the segment. Segment's only growing. I appreciate the support. Keep on listening. Hammer that like button. Subscribe if you haven't already. Make sure you reach out. And most importantly, share. Everybody have yourself a wonderful, wonderful trading week. Until the next time, folks, I will see ya. Don't forget to like, comment, and subscribe. Also follow us on our socials, Facebook, Twitter, and YouTube. If you have any comments or questions, you can email me, podcast@prospertrading.com. Thanks, everyone.